Well, thanks, Ken. Well, welcome everybody to the March edition of the Roundtable. I'm joined here tonight by Ken Kavula, Lynch, and Hugh McManus. My name is Mark Robertson. We've been doing this now for nearly 5 years and having a lot of fun trying to pick some good stocks along the way to bring to your attention. And it really is, the idea is to share ideas. And not only that, probably even more importantly, keep track of how well those ideas do on behalf of all of us. Tonight, the four of us will be bringing what we hope will turn out to be good horses, as shown there in the left-hand picture, but the companies will be Caterpillar and MSC Industrial will be two repeat selections, and then Dril-Quip and PriceSmart will be two new additions to the companies that we talk about. We're also going to throw in a little bit of a challenge on an existing holding. So let's go ahead and get underway here. Here's kind of our standing agenda. Again, welcome everybody, especially if you're new, but we see an awful lot of very familiar names. Welcome to all the Mid-Michigan people and the people nationwide that tune in and check us out on a monthly basis. We'll take a look at results, and then we are going to challenge a company, Credit Acceptance, ticker symbol CACC. It's been absolutely on fire lately, so we're going to take a look at it and see maybe if it isn't a candidate to take our money and run. The four stocks that will be presented are all right there listed for you, and at the end, as always, we'll do an audience poll so you can pick amongst those four.
Mark, we have a hand in the air. It's one of our Mid-Michigan directors, Geraldine Priestcorn, and I'm going to unmute Geraldine and see if she has a question for us.
Absolutely.
Go ahead, Geraldine.
I'm sorry, I do not have a question. I'm on my iPad for the first time, and I'm trying to find your screen.
Okay.
Go ahead, and I'll play with it.
And
okay, thanks, Geraldine. Bye-bye.
in that case, she's just waving at us, Ken.
That's what it is. It's a wave. Okay.
Let's go ahead and take care of the legal paperwork here. This is an educational demonstration. It's an effort to demonstrate the principles and philosophies of the National Association of Investors, also known as Better Investing, and also known as the Modern Investment Club movement. At Manifest Investing, we basically take and attempt to distill the lessons we've learned over the decades from a very successful approach, patience and discipline to investing. But we'll be talking about real companies in real time. Just keep in mind that never is any investment recommendation intended. If you do want to add yourself or somebody that you know to the reminder list for this, the email address for Natalie Kavula is down there at the bottom, nkavula1@comcast.net, and you can fire off questions to any of us, but my email address is provided there for you, markr@manifestinvesting.com. Let's go ahead and get underway. Just a quick reminder what we're here for. All four of us will be identifying at least one of our single most favorite investment opportunities at the time. At this time, current stuff, we many times will share with you the source of that idea also. So sometimes you'll see lists. I'll be presenting a list of screening results here later in the show. We do keep track of what we pick here, and the long-term portfolio has outperformed the Wilshire 5000 a little bit. We'll show the details in a second. Our goal is to beat that by 5 percentage points over the long term. We think that's the goal established by George Nicholson and the Modern Investment Club movement, and that's what we shoot for. We do like to see more of our selections outperform the market than underperform. So we'd love to see them come in at about 60 to 70%. Here's a look at how we've done on a quarterly and then monthly basis since the beginning. Again, we're coming up on 5 years. We are running at a relative return of about 2 percentage points versus the market. So if you take all of our selections, compare how they have done versus the Wilshire 5000, the average result would be plus 2 percentage points ahead of the market. Again, we always compare the performance of a decision made versus what would have happened if we had just invested that money into a Wilshire 5000 index fund. And in this case, we're a couple points ahead. We'd like to get up to that red line. We'd like to live above that red line, but the trend has been quite good, and it's certainly headed in the right direction. About half of our selections, as shown at the bottom, have outperformed the market. That's been higher. We really would like to see that up more around 60, 70%, and I think it probably will over the longer term. There's a lot of companies right on the bubble that if they have a few good days, they would flick that over to being on the good side of the number. Here's a look at the top largest positions in the tracking portfolio, ranging from the most frequently selected company, Cognizant Technology, down to Air Lease at the bottom. The figures in parentheses represent the number of times they've been chosen, either by a knight, a guest damsel, or a guest knight, or the audience. We basically keep track of any times any one of those would choose the company presented. And then at the time of selection, or at the time the decision is made, we take $1,000 and invest it in. So on the very top line there, you can see Cognizant's been chosen 11 times. Most of those by our own Cy Lynch, and that has resulted in Cy being one of the hottest nights over the last 6 to 8 months, because Cognizant's been on quite a roll. But $11,000 invested into Cognizant is now worth $18,600. It is the largest, most influential position in the portfolio, but seemingly well positioned going forward. And just ranging down the page, you can see, again, anytime you see a figure in parentheses, it's the number of times selected, multiply that by 1,000, and then you can make some conclusions about the number on the right. Any comments or questions, guys? I mean,
I didn't realize Qualcomm had been selected so many times.
Yeah, it's been picked by many of us. You kind of have a monopoly on Cognizant, but
and Cognizant has a great projected annual return as well, which augurs well for the future.
Still looks pretty good. You still good on Staples, Hugh?
Yep. Next, Staples bizarrely has improved.
It really has.
Since I've stopped buying it.
And I guess the one that really grabs me on here is Universal Display down towards the bottom. About a year ago, Ken and I both selected it coming from different directions. The audience seconded our motion that night, so $3,000 invested has become almost $5,400. Those are kind of fun. You know, as well as the Bank of America. Everybody kind of held their nose when Hugh selected it 4 times, and you can see that that has not done poorly.
It's not out of the tunnel yet. I mean, it still has a ways to go.
Absolutely. But this is a long-term thing, right? The link up at the top is available to anybody who wants it.
That's an example of a company whose performance has improved.
Let's go ahead and press on. I thought one of the things we might do tonight, we don't do it very often, is talk about the possibility of selling a holding. And just as a quick matter of challenge evaluation, Ken, would you like to talk about, you know, how we might actually end up at even being in position to have a hot seat tonight?
Well, I'm not sure what your question is, Mark, but I presented Credit Acceptance Corporation, I don't know, a year and a half ago, something like that, and it's just been on a real tear. I happen to own it in my IRA account, and I appreciate Mark drawing it to my attention, because I'm afraid with all of the volunteer work that I do, my IRA suffers sometimes, and I haven't taken a good serious look at my IRA maybe in the last 6 months or so. This probably will be one that I will sell out of my IRA as well with the par where it is, but I'll certainly take the profits and bank them towards further retirement. Essentially, when I presented this, the audience agreed it was a pretty decent holding, so we dropped $2,000 into Credit Acceptance, and its value today is $3,500 with a par value in the negative range. Since our total par for the portfolio is only 10.2% right now, we need to raise the par a little bit. And the way that you raise the par is you sell off the bottom. If this were a real-time situation, I might move through 2 or 3 or even 4 stocks. with very, very low par values and consider selling them. I'd of course do a new study to make sure I have the most current up-to-date data. Mark and I both did a real quick study on credit acceptance and got par values anywhere from -1 to as low as -3.5. The one Mark's showing you, I think, is -2. Yes, it's -2 right now. So it's a good candidate for moving out of the portfolio. We'll freeze the positive 31% relative return. If only all my picks would do as well as this one. And we'll clap our hands and say job well done, and we'll look for some more stocks to take. If this were a real portfolio, I'd want to take this money and invest it in something that had some real good potential. And I wouldn't trade a -2 for a +2, but I certainly would trade a -2 for a +12 or +14, something along those lines. Is that what you were looking for, Mark?
Yeah, I think a lot of times we get the question, why don't you guys sell more often? You know, I think you already hit it. It comes back to, well, does the portfolio need it? And it rarely does. We rarely are in a situation where we have to improve the overall par of the portfolio, but in this case, the return forecast is low enough that it's worth kicking around a little bit. One of the other things that Ken said I want to draw everybody's attention to, if you look at physical therapy down here, U.S. physical therapy, the current update is actually going to take that to a return forecast of approximately 5% and a quality rating of 82. So, again, you don't want to get too carried away, and you always want to audit when you're in the middle of a selling situation. And that's basically what we're showing you here. This has served us well. The stock price has literally gone from $142 at the end of January to, in just 2 months, it's gone up to 195, as you can see here between the left column and the right column. So this thing has literally been on fire. It's probably going to cool off at some point in time.
Mark, we have a hand in the air. It's from Ed, and Ed is a member of one of my investment clubs and also a very active member of Mid-Michigan here. So, Ed, I'm going to unmute you and let you ask your question. Go ahead.
Hey, Ed.
Oh, another one of those folks waving at us probably. So I'm going to put the mute back on and take the hand down, okay?
And again, just to reinforce, I mean, when Ken and the audience picked it, this is a great company. Look at those lines. We're not saying it's a bad company. We're just saying it's potentially, at least temporarily, overpriced.
Mark, I do have a poll in place if we want to see what the audience thinks about selling CACC. I'm going to launch that poll right now and give folks a chance to tell us what they think about this sale. So here goes, folks.
A special poll ordered by the governor. I think this one makes sense because the audience basically shared in this decision back in September 2013, and the audience has been trending very well on the overall results. Give them an opportunity to do something they don't always get the chance to do, and that is lock in a very favorable situation.
All you do is take your mouse and click on either yes or click on no. If you're on a different device, you might try, if it's a touch screen panel, you might try touching next to yes or no. I'm going to try to get the voting up to at least 80% here. So let's see if we can push it. Let's get 3 more of you voting out there to get over 80%, okay? Well, maybe it takes more than 3 to get over 80. There we go. Okay, and I'm going to close the poll, and I'm going to share the results. And by an overwhelming majority, the audience agrees with the Knights that we should be selling CACC and freezing those 2 positions, one coming from me and one coming from the audience. So let's hide that. And Mark, you can continue with what you were doing.
Okay, so we'll go ahead and log that decision in. And again, that 31% relative return, again, that's annualized, guys. 31% annualized since September 2013 is not a bad show, and we'll lock in those results. So with that, let's go ahead and roll. We've got some good stock presentations for you here tonight, and we'll go ahead and get underway with Cy the Tool Man.
All right, thanks.
Cy, I'm going to stop you before you get started because we have a hand up from Ann, and let's see if Ann actually has a question on that last transaction. Ann, go ahead. You're unmuted.
Yeah, I was just wondering on the CACC if there's any thoughts or questions as to why it's running right now.
Well, the cursory look that I had, and anybody jump in if you have a stronger answer, is that their business has been doing quite well. And then if you look at the analyst forecast, the projections have actually been getting boosted a little bit, maybe more than a little bit. That is reflected, by the way, in that right-hand column on your screen. The fact that the analysts have been literally boosting things and expect the company to continue to be on somewhat of a roll, but the stock price again has gone up 30 or 40% during a period when the market hasn't gone up at all.
And I've liked this stock for a large number of years, and I first put it into a portfolio back at one of the times at Bink when we were picking stocks to take a look at. So I will keep this one on a watch list, and when it gets to be more fairly valued, it might very well go right back into my portfolio. But when the market hands me a big chunk of money by overvaluing a stock based on my analysis, I'm not afraid to take that big chunk of money and reinvest it and then watch the company that I really like for another entry point into the purchase again.
Okay, thank you.
We also have a question from Debbie. Debbie, you're unmuted. Go ahead. And Debbie must be waving at us, so I'm going to put her back on mute. And Cy, why don't you take it away now? I'm sorry to interrupt you there.
No problem, Ken. It's interesting. I noticed that you're doing PriceSmart. That popped up pretty high on my screens as well, but I decided that I would start a new string of repeated picks with MSC Industrial. That you can see, we first presented it back in January, and not a whole lot has changed. The price is about $2 less than when we picked it, and I'll be talking about the financials as we work through the slides. But what MSC does is they are in the industrial tool and equipment supply. They would be along the lines of a Grainger or a Fastenal type of company, probably a little closer to Fastenal in some respects, although Fastenal has more of a retail space and Grainger is much larger. MSC concentrates primarily on the metalworking industry, supplying tools and supplies for that industry. But that is MSC. They are the largest company in their specific space, and it's a very highly fragmented industry. So there's certainly some potential for growth. Let's go to the next slide, which I believe will show where I got MSC, or MSM is the ticker symbol. This is just a ranking of the roundtable portfolio by par. You can see that MSC Industrial is relatively high on that list. I listened to Hugh, and since it's fairly near its 52-week low, which actually hit 2 days ago, that is somewhat attractive to me. And quite frankly, because the market has been running up for so long, been over 3 years since we've had even a 10% correction, and the bull market itself is running more like 7 years old. I try and keep my quality standards very tight, and try and look for companies that despite the market could still be on sale, and I think MSC may be one of those companies. you can see the circles on other things that attracted me, the 97% financial strength, extremely solid financial strength, again, excellent quality at 88%, and then naturally the par value. So when I see numbers like that, when I know that the market is up as it is, I say, okay, is there something I'm missing? Did I somehow perhaps make a mistake in January, or is this just that nugget that the market is not recognizing right now? So let's take a look at a couple of the things that I do to check that. Next slide. Mark talks about this frequently and shows these sorts of slides. I go over to Yahoo Finance and take a look at the analyst estimate slide. This is just really just a preview to show you the top of the page. The next slide is really the key slide, but notice that the sales growth forecasts of the 14 analysts that give forecasts for MSM are running right in line with my projected 9%. They're 8% this year, accelerating up to 8.9% in the next fiscal year, that being fiscal 2016. And notice that there are 14 analysts, and keep that in mind as we flip over to the next slide. This is just scrolling down the same page. And one of the things that you want to take a look at is, have the analysts been decreasing their projections? And you see a little bit of a downward trend across the board. The first two columns on earnings projections are for the current quarter and the next quarter, and then the last two are current fiscal year and next fiscal year. And I've gone ahead and given you the percentages decline in the last 60 days, which is since I last picked it, and none of those are particularly anything to get worried about. And in fact, if you take a look at, I didn't highlight it, but the bottom rectangle area, the EPS revisions, it's actually only one analyst has changed in the last 30 days, and then that was a down pick. So out of the 14, only one has changed and has shifted the median down, as you see, but doesn't appear to be anything drastic that perhaps we're missing. There have been no news releases, and neither Value Line nor Morningstar have changed their outlook on the company in that time. So again, it appears that my initial analysis was good. Here is my Eagle equity analysis guide, and I've also shown you the consensus off of Manifest next to each of the key judgments. 9% sales. Actually, Morningstar projects as high as 11% there, so there's at least some potential upside if you go along with some of the more optimistic projectors. Net margin, again, I'm right around the consensus, slightly under. Again, Morningstar is a little bit higher there as well. PE, we've got about the same judgments at 19, 19.5, and all of that then leads to a projected annual return of 15%, 16% if you go with the consensus. So MSC looks like it is certainly a bargain, and I note that Grainger and Fastenal are also being held back a little bit. And I think that the biggest problem is that much of the world is in a recession, so there's some concern, and there's concern over is the U.S. economy going to slow down a little? And so some of these industrial supply companies the market doesn't seem real fond of right now, so this could be a good buying opportunity.
As he would say, an accumulation opportunity.
There you go.
All right. Well, thanks, Si. Any pressing questions at this point, Ken, or should we move on?
I think we're ready to move on. Si, it's really interesting. The Bridgeport Model Club is doing an industry study and they include MSC Industrial Direct, Granger, and Fastenal as part of that study. They're going to be presenting it in about 2 weeks. So their thinking's right along the same lines as yours, that there might be great opportunity in this industry right now.
It sounds like it.
So with that, why don't we go ahead and talk about opportunity down around the Gulf of Mexico, Ken?
Well, I'll tell you where I came up with this name. I did some screening on PriceSmart, but I did the screening from the point of view that I've always wanted to own Costco. I think Costco is a great company. I just really appreciate many of the things they do for their employees, and I appreciate the respect that they get in the market, but I've never in the last 5 or 6 years found a suitable entry point where I think Costco is cheap enough for me to purchase. So I went out looking for Costco imitators or Costco competitors, and I didn't find any in the U.S., but I did find this company, PriceSmart. They operate in the Caribbean. Mark, if you'll click once. They operate in Central America and the Caribbean. They were founded by 2 people that founded and used to own the Price Club chain. And some of you are old enough to remember Price Clubs, which were swallowed up by a competitor, maybe 20 years ago. When their company was sold to the competitor, they decided to go into business in a different part of the world, and they chose Mexico to start with and weren't very successful in their Mexico endeavors. But they moved to Central America and the Caribbean, and you can see today that they own 33 stores scattered pretty well throughout Central America. They're just now moving into South America with 6 stores in Colombia, and we'll talk about that in just a little bit. But they're pretty well distributed. This is an American company headquartered in San Diego, a major distribution hub, the primary distribution hub in Miami, Florida. So let's click once more. Next slide, Mark. Thank you. And I got this slide right from their website. You can get a pretty thorough presentation about the entire company from the website. That map up there in the upper right corner not only shows the stores, but it shows the distribution centers. Those are the yellow dots. One in Mexico City, one in Miami, and a couple in Central America, with another major center up in LA. They're a $3 billion company, pretty good-sized company for something that I had never heard of before. 36 warehouses, 3 of them brand new last year, and the growth potential, the company indicates that they plan to open for the next 5 or 6 years. They plan to continue opening stores at about the same rate. They own most of the real estate that they build on, and they have 1.3 million membership accounts right now and 2.5 million cardholders, and those cardholders renew their membership cards at an 84% renewal rate. 80% of their business is done to retail customers, with 20% to small businesses. Again, think Costco, think Sam's Club. They have the same type of clientele, and 2/3 of it in Latin America, 1/3 of it in the Caribbean. If you click again, Mark, please. You can see that the growth in these companies, where they've put a lot of their stores, is really more robust than the growth in the U.S. GDP, gross domestic product. That's the bar graph at the upper right corner. The United States growing GDP at under 3%, and compare it to many of these countries where these warehouses are located, you'll see growth rates double or triple or of the U.S. growth rate. That's certainly a prime piece of real estate to begin to sell things to people. warehouse clubs per population in millions. The United States has 4, if you count the number 4, and then you look to the Caribbean and Central America where you see that there's less than 1 club to the 2013 population in 1 million. So there's certainly room for building these clubs. The people are becoming richer, and the penetration is much, much less than in the United States right now. If you click again, Mark, you'll also see that they have the same general business model as a Costco does. They do target higher income and upper middle class families. And again, this 84% annual renewal rate. I don't know if most of you know it, but most of Costco's profits come from selling the membership to the Costco market, and the same model is being used by PriceSmart. The vast majority of their product comes from selling their membership card, which means they're selling a lot of their product at or very near cost. Extremely thin margins in these warehouse clubs if you look at any of them as far as margin is concerned. They have 3 types of membership. They're not all available in all the clubs, but most of their membership focuses on this diamond account, and that's an annual fee of $35. It went from $30 to $35 in 2012, and it didn't impact immediately the numbers of account holders, but it did slow the growth just a little bit. You can see that from 2012 to 2014, the growth in card holders slowed as the price point took hold. One more click, Mark. I'm looking at what I like to call up, straight, and parallel. Those of you that are out in mid-Michigan probably are chanting right along with me right now. And I didn't knock out those earlier years because they were bad. I knocked them out because the growth in those earlier years was even more spectacular than the growth in the last 6 or 7 years has been. So since the recession, which is very difficult to even see on this particular graph, since the recession, the company's been on a pretty good roll with nice, strong, consistent sales growth and nice, strong, consistent earnings. If we look at the eagle that I put together, I looked at the numbers very carefully and chose to stick with the default numbers that are on the eagle, the equity analysis guide that we can create pretty easily anytime we need one. It's showing me a return of about 15 or 16%. That's dead on top of the same return that I got when I did a traditional SSG. So I'm pretty comfortable with what's happening. Now, all that being said and done, PriceSmart's not soaring in price right now. It's a little bit depressed in price, and Value Line makes the point that the recent expansion into Columbia perhaps went a little bit more quickly than the company anticipated, and some of the costs for opening the 6 new stores over a period of 3 years were a little bit higher than they expected. They also find that they're doing a little bit of cannibalization of their existing stores, which they didn't account for when they did some of the planning. The management is insisting, however, they're going to go ahead with their expansion plans and keep moving to serve a very underserved population. Colombia is the 4th largest economy in South America and has the 3rd largest population in South America. and they feel that moving into Colombia is right for the company, and they feel that once they gain some traction and people start repeating the business, that those stores will perform at the same level as the stores they currently have. I've put a little bit of money into this company myself. Two of my investment clubs have put a little bit of money into this company, and I'm suggesting that it's a nice addition to our portfolio. We don't own a lot of consumer staples stocks in this portfolio, so I'll suggest that we add this one going forward. Thanks, Mark.
Thank you, Ken. We certainly have had a lot of fun with Mercado Libre over the years, so this is not terribly different theme, I don't think, and interesting area of opportunity. Just out of curiosity, did you run into the word Cuba at all?
Not yet. I really think that whole situation is too new for the company to have reacted to it. The investor relations packet that I got and that I read through, and the presentation that I reviewed was dated about the first week in March, and I think that was pretty close to when the openings to Cuba became something that people could begin to think about. Ann is asking, what year did PriceSmart go public? Ann, I'm not going to give you an exact year, but I'm going to tell you that it was at least 10 years ago, and I'm thinking maybe it was 12 or 13 years ago. Again, there's a great investors presentation right on their website, PriceSmart.com, and if you're interested in this company, I'd urge you to begin your research by just doing an overview of the company, by looking at that investor presentation, and then by reading what Value Line has to say. There is no Morningstar report for this particular company, but there is some other available information out there for you to read through.
Okay, I think we'll go ahead and press on with one of Hugh's old favorites, Caterpillar.
Good. You can hear me all right?
Yes, you're coming through loud and clear.
Perfect. So I will keep this short and sweet. Where are we time-wise? Okay, yeah, we're okay. I'll keep this short and sweet. Caterpillar is a company that I've added to the portfolio a few times in the past. It has been depressed price-wise for a while, and I think it will continue to languish going into the next few months, even a year. So as Mark quoted said, it's a good thing to accumulate. So let's move on. You can see the sales have been flat for a while. And I'll go through the same mantra every time. I have a number of different companies that I look at, particularly for this portfolio. And if you skip to the next slide, you'll see that I kind of rank them, how close they are to the bottom of a ladder. So on the next slide, you'll see a ladder. So the 52-week low is in the bottom rung, and the 52-week high is in the top. And if you're halfway up that ladder, you're 50% of the way to the bottom. If you're near the bottom, you might be 5–10% of the way up that ladder or close to the bottom. And I like to buy companies that are close to their 52-week lows. And I see I've got an early convert there in SI, which is good. Saves a lot of work, actually, if companies are cheap. Of course, they can continue to fall, but if you buy a quality company, chances are you're buying it when it's having a bad patch in the market, and ultimately it recovers. So flipping to the next slide, you can see that when I've added the Manifest Investing Quality rating to this and the projected annual return for Manifest, and I look at the dividend and the dividend yield, but I really focus in initially in this screen as to how close it is to its 52-week low. And you can see American Express, talked about Costco recently, hasn't done that well. It's down near the bottom. It's getting booted out as the exclusive purveyor of credit cards to Costco. American Express being a strong indicator that you're dealing with upper middle class income families. And AeroVironment, we've looked at that in the past. ConocoPhillips and BP are suffering right now, as are all companies in that industry, as gas prices are depressed. Crude oil, more correctly, is depressed. And generally, when companies are near the 52-week low, let's see quality alone for a second, but the projected annual return tends to be high, and in some cases here, it's nice, strong double digits, as is the case for, say, Microsoft, or even Bank of America or Monsanto. The quality ratings for these companies, most of them are acceptable, some of them are excellent, and unfortunately for BP, it's a little bit iffy down at 52. But Bank of America has recovered quite substantially, now being up at 80. So on the next slide then, I just look at the companies that are near the bottom, and I tend to focus on companies that are as close as possible to the 52-week low, and as long as nothing is happening with that earnings engine, the company is still a quality company, then I would analyze it further, doing a stock selection guide, looking manifest investing. And if it's a large cap company like Caterpillar, I want it to be near a 52-week low. And as I said before, I refined it a little bit for mid-cap companies. I want it to be close to a 2 to 3 year low, and for small guys, even a 5-year low. These tend to be one-hit wonders, especially in the biotech industry, and when things happen, the company stock price can get horrendously badly depressed. But as I said, as long as that earnings engine is intact, chances are that it will come back and it will recover. And so here the company that I've picked is Caterpillar. It's in the portfolio, so I have a tendency to add things back into the portfolio that I've added before. And just for completeness, we just saw the last slide, companies that are near their 52-week high. The Sigma Aldrich right down there at the bottom is about to get acquired by Merck in Europe, not the US Merck. So it has shot up to that purchase price of, I think, $139 or $140, so somewhere in that range. And it will sit there for the next 3 months before that acquisition is complete. But Aflac has recovered nicely. It's up near its 52-week high. As are some other companies, like Home Depot was near a low for a while, as was Pfizer. Now they have bounced back. And with the exception of Aflac, which is a projected annual return of 12% I see here, I'm going to double check to make sure that's not a transcription error. Generally, companies near their 52-week high have a lower projected annual return. But for a quality company, the quality rating should be impervious to really where it is on that ranking. And Freescale is just a bit of an anomaly there that I'm tracking that company. I'll eventually stop doing it. I have to get rid of it out of the portfolio. It's done quite well for me. I think it was a spin-off from Intel at one point, or maybe it was Motorola, I can't remember. But I ended up with shares of that thing. Anyway, skipping along. So as I said, Caterpillar is on sale, and I'm just going to give you some information that I got from an analysis of Caterpillar, or a summary of its performance in 2014, and some of the highlights in that document. It was a long document of about 50 pages, and you can download it from its website. The take-home lesson about Caterpillar is it's languishing in Asia at the moment, and that's important for the company's top line, and it probably will continue to languish. It's in that kind of an industry, particularly in mining, where companies can decide not to buy equipment for a few years, and they don't really suffer as a result. If they stop trying to take oil or diamonds out of the ground, they've been in the ground for millions of years, a few months, a few years, even 5 to 10 years delay will not make a huge, those diamonds aren't going anywhere. So they can hold off doing that and come back and dig them out when the overall economy has recovered. Having said that, Caterpillar didn't do too badly last year, generated $55 billion in revenues. It has $7 billion in cash. It has strong operational performance, particularly in energy and transportation. Mining was bad. Construction did okay, but mining was a real drag. It increased its dividend, interestingly enough, by 17%, so it actually put back about $1.2 billion to shareholders in the form of dividends, and bought back shares at the rate of $4.2 billion. I'm always nervous when companies do share buybacks because they're historically very bad at doing it. If you looked at Caterpillar 10, 15 years ago, it was a completely different story to what you see here. Where you see now the U.S. business, which was dominant 15 years ago, is now less than 40% of its global sales by geography. And Asia, America, and Latin America, and then the rest of the world account for $10 billion in total. Really spectacular amount. And this is for its area in energy, etc. If you move on to the next slide, a little bit of a busier slide, but if you want, I can send people a link to where you can get this document. It shows that there's consolidated sales and revenues on the top right, and a breakdown by the different areas where it's in. Energy and transportation, the top number in the darkest color, did very, very well, but mining, which is an important contributor to the company's top line and bottom line, did extremely poorly. But its financial services, leasing, etc., has done quite well. What's interesting on the top left, when you look at the sales, they really did peak in 2012 and have been slowing down ever since, as we've seen slowdowns in different parts of the world. And Caterpillar is differentially impacted by emerging economies, where the sorts of services it provides tends to be extremely important. Having said that, we're going to see in a minute where Caterpillar is critical in the U.S. as well. If we move to the next slide, it shows how Caterpillar has treated its shareholders. It's accelerated its capital expenditures as a percent of sales into 2012 and then slowed down as its top line declined. But it's still held steady in R&D. It has been relatively stable in profitability, even though it has declined the last 2 years, but it has continued to increase its dividends to shareholders with quite a dramatic increase in dividend last year. And then moving along, you can see that manufacturing in the U.S. is certainly not dead or far from it. This is from the report. It says it's 12.5% of GDP. The interesting thing to me that 19% of patents issued come from manufacturing. I guess it depends how you define manufacturing. Certainly anything in the the chip industry or microelectronics would count for that. But it supports 1 in 6 jobs. That's not to be sneezed at. I think anyone who would lament the fact that manufacturing has gone from the U.S. needs to look at statistics from the Department of Commerce, which would suggest otherwise. And in fact, if anything, manufacturing in the U.S. is on a little bit of a rebound in certain critical areas. Moving on to the next slide. We'll see 2 slides, performance by region. It's really invested heavily in North America, that's Canada and the U.S. It has a lot of employees in that area, about half that number in Europe. Revenues are lower in Europe. It's still a growth area, and it will continue to be a growth area once the beta test for fracking has finished in the U.S. and Europe starts to embrace that. Now, moving along to the next slide, you can see where the real growth has been recent, and that is in the Asia and the Asia-Pacific Rim. But things are slowing down there. I read a statistic recently where, in terms of its effort in mining, and machinery related to that area, it has dropped by as much as 40%. That's not something that will be permanent, obviously. That will fix itself over time, but it will take a recovery in the economies there for that to occur. And so moving along to the next slide. The conclusion is, and I didn't do an SSG for this, I apologize. I went back and forth on this and decided I'm not going to do an SSG, see how it goes for this talk, but I think I should have done one. I'll do one in the future. Just a matter of printing the thing out. And for those of you new to this whole thing, SSG is an acronym for Stock Selection Guide. It's a method for summarizing financial information and getting a rapid decision on whether this company looks as if it should be considered as a buy, a hold, or even a sell. So it's a very good guide for investors like me. So it's a leader in its field. It has competitors, obviously. Its 2014 performance was good, but not great, and it does expect a very tough year this year. So I think there will be more buying opportunities for Caterpillar. I own it. I've started to buy it in the last number of years. I'm now able to buy it at a lower price than I bought it at initially, which I always enjoy. I no longer suffer pain when I have to do that. And I will continue to do it if this stock price languishes. But I think as a company, its long-term prospects are sound. And for that reason, I will personally continue to buy it. And I've suggested that others look at this company and consider for yourselves whether or not you wish to own it. So with that, a dog lover, I will leave Cat to you.
Okay. Well, thanks, Hugh.
You're welcome.
Certainly worth taking a closer look at. And it is the long term. And again, we were inspired last summer by some work we had done with the founder of Value Line and Arnold Bernard by name. And I think Hugh had a lot of, he was basically moved, or at least we were reminded of him and legions of investors who invest in these high quality companies and basically hold them for a very long time. So most of the companies that Hugh was talking about, he has this vision that they're going to be there for quite some time, and that accumulation can be quite a rewarding opportunity. What I thought I would do is take us home with Dril-Quip here, but spend a little bit of time reminding, what do we really do? Why are we here? What's it all about? and we're here for the returns. It's something that we really talk about a lot in our webcasts and our person-to-person, face-to-face sessions. We build forecasts. We develop expectations for the companies that we study and ultimately own and steward. And we want companies that have above average return expectations, perhaps 5 percentage points better than the average stock. We don't want to get too greedy and reach too high. We know that sometimes when people reach for those stocks that have return forecasts that really are too good to be true, you can get burned or strike out, however you want to think about it. Many times when you see a forecast that is literally in orbit, it's just really a matter of they haven't figured out what's going on or what's possibly going wrong, as we say here, shoes not dropping yet. So we really care first about the return forecast. Second, quality. We like excellent companies. We like leaders in their industries. We like to measure it. We know that accumulating and maintaining a portfolio with enough core, high-quality companies will help us during the tough times, corrections, recessions, bear markets, depressions. You could say, Mark, we haven't had a depression in almost 100 years. Well, that's really not the case. You can have an industry depression like we saw in home building, where it literally just wrecks the industry. So that's a situation where we can have localized, either regional or industrial, industry-based depressions. We think financial strength is important. We also like consistency of results. We like companies that are positioned and have demonstrated a capability to grow faster and at a higher profit level than their competitors or peers. A lot of times it's an instant industry study. Anytime we compare, something like size MSC Industrial, ticker symbol SMM, to other companies like Grainger. In fact, I started with Grainger as I was working through this stuff for this month's session. So we think it's important to keep track of them over time. Quality matters. It matters big, and it matters big over the long term. And so I'm basically going to go out there looking for companies that are in the top 3 percentiles, very top of the heap of all the companies that we study as we do this. The third thing that we know is absolutely imperative. It's to get the growth rate. For purposes of the overall portfolio, we think that it's important to select from the smaller, faster-growing companies and blend them with the stalwart blue chip companies, and then have those workhorses in between. But the overall average, it should all add up to a puzzle or a pie, however you want to think of it, somewhere in that 10, 11, 12% range. Growth rates less than 3%, you can invest in them, you can make money. I would regard them as special situations. Mr. Nicholson once remarked that he lost interest rather rapidly in a company growing less than 3%, so it really is kind of a stake in the ground if you want something to lean on or bite into. You can go there, but again, for any company that you're looking at that has a growth rate of 2%, you probably better have one that's 15 or 18 or 20. So for our purposes here tonight, I'm going to confine the shopping to growth rates of at least 7%. And again, that bell curve is just to remind us that there's, a whole lot of companies, in this case east of 7 or 8%, and they help us with that average. Financial strength matters big. You heard Cy talk about it earlier. When return forecasts are elevated pretty much across the board, financial strength is a very important core component of quality. It does factor in the stuff that we would expect it to. How lend-worthy is the company to creditors? How strong is the balance sheet? All that stuff is part of what keeps them out of trouble when that next difficult or challenging time hits. So I'm going to restrict any shopping that I do here tonight to a financial strength rating that would be equivalent to a value line A or 80%. All right, so return forecasts are important. Building expectations, quality keeps us safe. Growth, the right amount of growth is important. Financial strength is also important. You can see the selection criteria there. We love consistency, especially for our core portfolio or that component of our portfolio. That stability of profitability is crucial. We really do believe that stock prices follow earnings, and you don't have to look at too many visual analyses to know that that is certainly true. It's not always instantaneous. Sometimes you get rather weird periods of time that can be a plateau for an extended period, but ultimately over the long term, the stock prices are going to follow those earnings. So you can find some really decent opportunities in some of those special situation stocks that are a little bit bumpier, that have the lower EPS stability ratings. You can actually find bigger or outsized opportunities. But again, be careful when you're doing that. Especially be careful under market conditions like now. I do believe we're a little bit more vulnerable to larger corrections. So for right now, again, this is time specific, we'll stick to the top 3 deciles above 70 for EPS stability. It's not something I pay a lot of attention to normally, maybe dropping that down as much as 50, but under present day conditions, maybe 70 will be good. What you end up with is what I would refer to as a dynamic pounce pile. And I know it's a little bit of a busy slide, but just looking down the names there on the left, you'll see many familiar and community favorites in the mix. Anytime the ticker symbol is bolded or in blue, it's part of the most widely followed companies by you guys, or it's already in the roundtable portfolio. So you can see a large number of these stocks that met those screening criteria are actually doing pretty well. I did make an exception to leave Qualcomm on the list, even though it has snuck down below 7%. That's a temporary thing. I think they'll probably continue to maintain 7 or above. That's just a rounding error. So again, all the companies going from left to right have all the characteristics are listed here, so you can check them out. These are actually listed from top to bottom, descending by their return forecast, starting with Priceline at 18.8 all the way down to Moody's at 9.8. In fact, Apple even checks in at a pretty good number, around 10. Keep in mind that the average stock right now is somewhere in that 5 to 6% range, so these are all above average. The ones that we really like are the ones in the middle of the pack here, so-called sweet spot. So those would all look pretty good to us. The quality rating, we know they're all going to be 97, 98, 99, or 100, so these are all pretty good companies. And then we follow that with a series of other opinions, starting with Value Line, the Value Line low total return forecast. They get kind of grumpy or pessimistic from time to time, and I think they're kind of going through one of these right now. Whereas Morningstar and S&P thinks the market is generally pretty fairly valued. In other words, probably an overall return forecast in that 8, 9, or 10% range. Value Line is actually down lower than that for the typical stock in the Value Line investment survey. Again, I think they're probably a little bit pessimistic. The problem with that, though, is historically that has been the most frequently occurring actual. I know it's kind of a weird way to put it, but when we look at how well do predictions do, this is one of the better predictors that we've seen in the stock market going back over 50 years. So that should perhaps nudge a little bit of caution into some of the stuff that we do. Some of the returns are a little bit frothy. Fossil, they're going through some interesting challenges with the Apple Watches. Some of these actually look pretty good. The Morningstar and Standard & Poor's price to fair value is, again, anything less than 100% is potentially on sale. The ones that are color-coded in green are the ones that are at least a standard deviation. They're basically down the bell curve or more on sale than most companies. So you can see Priceline is one that Morningstar would have a high level of interest, even Google. In the case of Standard & Poor's, they think things are more on sale than Morningstar, believe it or not. And they see some value, including with Fossil, Aaron's. And then 2 other categories, we're just kind of watching the 1-year target prices from both the analyst consensus and the Standard & Poor's analysts who work for Sam Stovall. And again, this can be probably the best way for me to think about this is, we attempt to follow some sentiment indicators in kind of tie-breaking situations or that sort of thing, or maybe we'll get down to having 2 companies that we really like, then we find negative sentiment stacked up against one or the other. And I kind of have a hard time getting my arms around some of the sentiment indicators that are out there. This one, however, has a little bit more merit to me. This is basically what the analysts are telling investors and traders that they work with. And it's going to be interesting to watch these numbers move around as we pay closer attention to them. This is basically sentiment with influence that has impact on companies. From the analyst consensus to the S&P. S&P can be a very influential one. I may add Goldman Sachs to this list at some point if I get around to it, because again, a company like Goldman Sachs, the sentiment that they have as measured by their target prices can be quite an impressive or powerful influence on stock prices in general. So again, just looking down this list, you can basically start to go shopping. Size Cognizant Technology is on here, but the one that really grabs me, I was trying to find something a little bit different. Dril-Quip, DRQ, ticker symbol here. Stock price in the high 60s, decent characteristics, checks in with a decent return forecast of 12 to 13%, a little bit frothy on the value line side. It's not covered by Morningstar or S&P with respect to establishing a fair value. It's a relatively small company compared to some of the others in the field, but a decent outlook over the next year, according to the one-year analyst consensus outlook. So let's go ahead and take a look at these guys. This is Dril-Quip. We're going to talk about what they do here in a minute, but the visual analysis actually looks pretty strong. This is an oil and gas field equipment and services supplier, so you'd expect them to be bumpy. I mean, they're obviously going to be tossed around with the tide, the ebb and flow of the energy industry. So I would almost expect, without looking at this, without seeing it first, a whole lot more bumpiness in the earnings trend that you see there. That's actually relatively flat considering the challenges that they face in their global market. So, but, you know, for a company, you know, fighting in that very competitive, very volatile market, these guys apparently do pretty well. This is probably even more powerful. This is a look at their profitability as measured by their net margin over the last several years. They do ebb and flow a little bit, but you can make a pretty strong case for a number somewhere in that 20% neighborhood, maybe high teens, if you want to think of it that way. Here's a look at their PE ratios over the years, and again, I think you can make a pretty powerful case for, even if you kind of drop in and say, it kind of looks like a aircraft coming in to land somewhere in that 20 range. Again, that PE ratio showing that generally increasing tendency is basically a sign of respect that the company has been achieving. You know, those 20% profit margins on the preceding page are quite powerful. So 20% profit margins, net profit margins, and the long-term average PE here is about 20. So those are some pretty good reference points as we think about where this company may be headed going forward. So we'll build a return forecast. This was the value line standard edition forecast based on early February. The stock price at the time was in the $78 range. 12% growth forecast, 20% net margins. Again, we're talking about value line had a long-term expected PE ratio of 22 at the time, and relatively elevated. Not as elevated as some of the others that are going through a nightmare in the energy industry, but quite elevated. If you look at the situation today, they've dropped another $10. Some of the analyst expectations coming home for 2015 and 2016 have driven down that long-term trend closer to 10%. So that's what I used. Again, stuck with the 20 based on the chart that we were looking at. Came in a little bit lower with the 19. We're still talking about a return forecast of 15 or so. Again, a projected annual return of 15 or so when the average company is down in that 6% range. So that's pretty robust. Here's what they do. They make stuff for the energy industry, specifically heavy stuff that can get wet. Do have some electronics involved, but heavy stuff that's probably pretty expensive. As Ken often suggests that we do, I would highly recommend that you take a look at Dril-Quip.com. You can click through on the investors section, and you do have access to all of these presentations. This one was made just last week down in New Orleans at an energy conference, but you get an idea of some of the stuff that they make based on the picture that you see there. Something else that is helpful, who are their competitors on the left-hand side? A division of Schlumberger is a competitor with many of the things that they do, as well as FMC Technologies, and also General Electric Oil and Gas. That's the old Vetco Gray people. Used to be some of my colleagues back in my combustion engineering days, so I know they are quite formidable and part of General Electric. So these guys do compete, and in some cases they're clients of, but in most cases they're competitors with some of those major oil and gas, especially offshore and submersible type stuff on the rigs. But as you can see, their customers on the right-hand side represent pretty much a complete smorgasbord of all the major integrated oil and gas companies out there. Here's just a quick look at just a demonstrated concept. Again, pay the most attention to the bottom half of this slide, where it's basically the stock price of Dril-Quip superimposed versus the price of, in this case, West Texas Intermediate crude, the price of, basically the price of gas, the price of petroleum. And you can see back in the post-Olympics Chinese moment, back in this time frame, the company took quite a hit, as well as did everyone. Everyone involved in energy industry took this basically body blow back at that time, the last major disruption. And then since then, the price at the pump has been on a fairly steady increase until fairly recently. You can see this time we're not seeing quite the same plummet down, but it's vulnerable. I mean, it could head down that way. You know, one thing that I think is kind of interesting is that it's behaving quite well. I do think that the price of gasoline at the pump could be back in the $100 range in the next few years, probably sooner than many people think, just looking at the long-term trends. But it'll languish for a bit, and who knows what will happen to the stock price of some of these companies. Having said that, you know, Dril-Quip back in the 2009-2010 time frame basically doubled and tripled in price back in that time frame. That is something that could happen again. It probably will happen again. And again, these companies are a function of what's going on. This is Schlumberger, going back 20 years in this case, and you can notice that there is something of a correlation. Anytime that the price of petroleum takes a hit, this company has to take a hit. You know, rigs are shut down, their market changes. And we're obviously in the middle of one of those right now. It doesn't appear to be coming down as much as it did, maybe a little bit more similar to what happened back here, but it has taken a hit. This is a very highly regarded, high-quality company that just keeps chugging along, and we do get these buying opportunities from time to time. Here's a chronicle for Dril-Quip. Probably the highlight of this slide comes in 2 or 3 different places. First of all, the quality trend. I mean, this company just keeps getting stronger and stronger over here over the last few years. The projected annual return is at, missed with my target here. The projected annual return is at a relative multi-year high. And then the same token, the projected relative return, again, that's the return versus the stock market. Anytime that this pink shaded area is between 5 and 10, the company's in the sweet spot. So the company is literally smack dab in the sweet spot with historically high return forecasts and greatly improving quality situation. That just means they're getting stronger versus their competitors. So again, I see it as an opportunity. Definitely worth taking a look at. And here's your reminder, the company has a still relatively small company, you know, based on the industry that they're in, but considering the challenges that they face, these guys have handled things quite well. In that investor relations section, I would encourage anybody thinking about investing in the company that's worried about what they're going through, you know, take a look at what they say about inevitable downturns in the market and the types of things that they're doing to address and handle them as best they can. This slide would suggest that they certainly have the capacity and wherewithal to, you know, handle those downturn challenges as best they can. And looks like a pretty good plan, pretty good operational plan in place going forward, and going to add it to the portfolio tonight. So with that, Ken, I think we can probably turn to a poll.
Well, Mark, we're all caught up on questions. Ann would like you to go back to the slide that showed the top holdings, and if you could do that just for a couple of seconds.
Top holdings or my screening results? Which one?
The top, I think the top holdings, the one right from the introduction of the program. And Ann's not shy, so if we're wrong, she'll tell me real quickly here.
Cool.
And Ann will flash that up there for just a little bit while I'm getting the poll ready to launch. Folks, we're going to ask you to pick one of these 4 stocks or none of the above, if you're comfortable with that. And here we go, and I'm going to launch the poll. You just have to use your mouse, folks. Just go over and pick one of the 4 stocks or pick none of the above, and we'll try to get the voting up around 85% if we could.
If you need a tiebreaker vote, I'm willing to chime in.
Well, it's not close right now, Mark. Okay.
I'd probably go for PriceSmart.
Okay, here we go, and let's close this. And let's share the results with everybody. And the audience, in fact, went with PriceSmart also at 38%. So we will put in an extra helping of PriceSmart into the portfolio.
Well, it's a good story. You know, assuming that these guys can really manage the situation well in Colombia, they've got such a wonderful field of opportunity.
Mark, we just did, again, in the same investment club, we just did an industry study about 3 months ago, I think, that included Dril-Quip, National Oil Well, Varco, Oceaneering International, Schlumberger, and one other company. And what we found really interesting about Dril-Quip and Oceaneering was that they don't sell very much. But they lease an awful lot of stuff.
Right.
And our conjecture was that the fact that these leases were long-term had a lot to do with smoothing out those sales lines and those earnings lines, especially since many of those leases were being renewed on a regular basis, up in the 90% plus range of renewing the leases. So just an interesting factoid to go with Dril-Quip there.
It's good management. The other thing to keep in mind as you study the company is that they apparently do a sizable amount of refurbishing, where they'll take return equipment from the field and restore it to a working condition. And there's a whole lot of equipment that is literally being shipped in and fixed up for the next big run. And that's probably another leveling strategy that they have. I'm gonna take a much closer look at the company because again, they handle themselves so well in such a challenging industry.
There's another thing too about leasing. This is 10 or 15 years ago when I looked at this in the airline industry, but the tax benefits can accrue not only to the company doing the leasing, but to the company that receives the equipment as well, even though they don't own it. And there's certain tax benefits from depreciation that benefit all the parties, even to the extent of over 100% the value of the asset.
We're having a question.
I don't know if it's still there, but
we're having a question from Ann, and I'm going to answer it out loud because it's a pretty general question. She wants to know, are these slides available on the Manifest Investing site? And in fact, the entire roundtable has been recorded, and we'll have it posted on the site within the next week or so. And at that point, you'll be able to access the entire production, including all the slides. We're getting some nice comments about 4 really high-class, interesting companies this evening. Very difficult choice, a number of people are telling us in their voting this evening. And Terry would like to know, does PriceSmart have any operations in Venezuela? And Terry, the only stores that PriceSmart has on the continent of South America right now are in Colombia. And at the moment, they plan on building out stores in Central America and the Caribbean. There are no plans, at least for the next couple of years, of moving any further into South America on the continent itself. I'm looking for questions, and Mark, this is a rare night that I've been able to keep up with the questions.
Well, I think with that, then we'll just go ahead and point out that there are a few opportunities to come out and see us. The roundtable for April will be 1 month from today on April 30th, but Ken, you and I are going to be together in Grand Blanc on May 2nd.
Right, we have Stockfest for all the Mid-Michiganders in the Southeast Michigan chapter and the Capital Area chapter. We'll be at Stockfest 2015 in the Holiday Inn in Grand Blanc. We'd love for as many of you as possible to come on over and hear us. If you need information about enrolling, drop me an email. I'm getting a hand up. Nope, the hand's gone down, so they were just waving at us here, okay? But Mark, we have been able to keep up with all of the questions, so with that in mind, we can close down tonight's roundtable. A great big thank you again to Hugh and Cy, especially. You guys are just great for doing this. We appreciate it immensely. Mark, as usual, great job on everything, and thank you for all the time you give us so unselfishly. And we hope to see everybody a month from now. The April roundtable, Mark is right, will be on the 28th of April. That's the 4th. I'm sorry, I told you incorrectly. It'll be on the 30th of April. That's a Thursday night. So 1 day short of a month from today is our next roundtable, last day of April.